Namaskar dosto, welcome back to Dhwaj Stock Info. Today we are going to discuss one important subject, how to read a balance sheet. Expert eyes on numbers, no CA degrees required. Before you buy a second-hand car, what you do not just look at the paint and the tires. You take it to the mechanic. You take it to the mechanic and ask for a health report. The mechanic checks the engine, the brake pads, the transmission fluid. If the report is clean, you buy it with confidence. If the report has red flags, you just walk away, no matter how good the car looks on the outside. Buying a stock without reading a balance sheet is exactly like buying a second-hand car without the health report. The company might look great, good revenue, good profit, good news, but underneath the balance sheet could be showing signs of deep financial trouble. In episode 11, I gave you the 7-point framework to pick up the winning stock. Today in episode 12, I teach you to read a single most important document in the framework, the balance sheet. And I promise you, you do not need a CA degree or MBA to understand it after the next 12 minutes. The balance sheet is built on one simple equation: assets equals liabilities plus shareholders equity. Let me repeat that: asset equals to liabilities plus shareholders equity. Here is what each of those words means in plain English. Assets, everything the company owns: factories, machines, cash, products in the warehouse, money customers owe them. Liabilities are everything the company owes: loans from bank, money owed to suppliers, taxes payable, etc. Shareholders equity, what remains after paying all the debts. Asset minus liabilities, this is the net worth of the company. It belongs to you, the shareholder. Here is the most important rule for the balance sheet: it always balances. Asset always equal to liabilities plus equity. Always. If it does not balance, something is wrong in the accounts. This one equation, 4 words on each side, is the foundation for all the financial analysis. Every balance sheet has exactly 3 sections. I am going to walk you through each one. By the end of this section, you will be able to open any Indian company balance sheet and immediately identify what it matters. Section number 1, A, assets, everything the company owns. Current assets, short term, covered to cash within 1 year, cash and bank balances, trade receivables, money owned by the customers, inventory, finished goods, raw materials, short term investments. Key: more current assets is equal to more liquidity. Non-current assets, long term held for more than 1 year, property, plant and equipments, land and buildings. Intangible assets, brands and patents, long-term investment in other companies. The key: high goodwill without earning is risky. Then comes where you look at the asset section. When you look at the asset section, the first thing you check is the cash. How much equal cash does the company have? The company with 500 crores in cash and no debt is a fortress. It can survive any downturn, any market corrections like one we have seeing right now. The second thing I check is the trade receivables. Is this money customers owe to the company for products already delivered? If the trade receivables are growing much faster than the revenue, that is the red flag. It could mean the company is struggling to collect from customers, or worse, recognizing revenue that will never actually be paid. Next, B, liabilities. Every company, everything in the company owes. Current liabilities due within 1 year must be paid soon. Short-term bank borrowings, trade payables, money owed to the suppliers, advance payment received from the customers, tax and salaries payable. The key: current ratio is equal to current assets plus current liabilities. Current assets is equal to current assets divided by liabilities. Non-current liabilities due after 1 year. Long-term obligations, long-term bank loans 5 to 10 years, debentures and bonds issued, deferred tax liabilities, provisions for gratuity and pensions. Key: rising long-term debt is equal to serious red flag. The liabilities section is where most investors stop reading, and that is exactly where they make their most expensive mistake. The current ratio is my most important calculation on the liabilities side. Current assets divided by current liabilities. If this ratio is above 1.5, the company can comfortably pay its short-term obligations. If it drops to 1 or below, the company cannot cover its near-term bills with its near-term assets. That is the genuine liquidity crisis in May 2026, with Nifty correcting. Companies with current ratio below 1 are the ones that may face serious troubles. Companies above 2 are the ones that will survive and eventually thrive. Equity, the owner's net worth, share capital, reserves and surplus, retained earnings, net worth, money raised by issuing shares to the public, surplus profit kept inside, growing reserves is equal to healthy sign. Profits not distributed as dividends, reinvested in growth, assets minus liabilities, what shareholders actually own. Now, the equity section tells you what the shareholders actually own in this company after all the debts are paid. Growing reserves every year on year is one of the most positive signs in the balance sheet. It means the company is profitable, reinvesting its business and building wealth for shareholders. Negative equity where liabilities are greater than the asset is the most dangerous red flag of all. It means company technically owes more than it owns. In 30 years of my banking, I have seen companies with negative equity collapse with a devastating speed during the market corrections. This is the number you check first in a distressed market. 5 red flags and 3 green signals you have to watch. In 30 years of evaluating companies' financials for lending decisions, I have seen patterns that repeat again and again. These 5 red flags appear in companies that are heading for a trouble, and the 3 green signals appear in the companies that are heading for a long-term wealth creation. Study them carefully. Red flags, what it means. What it means. Actually, negative equity liabilities exceed assets, and company technically bankrupt, owes more than what it owns. Very high risk. What is your action? Walk away immediately. Exception only for new startups. Then number 2, current ratio below 1. Cannot pay this year's bills with the year's assets. Liquidity crisis, investigate deeply, that could be on payments. Then green signal number 3, trade receivables growing much faster than the revenue, customers not paying or revenue being recognized before it is collected. What is the action? Check cash flow statement. Is cash flow actually coming in? Debt rising every year while profits stay flat, borrowing to survive, not to grow, interest costs eating the profits. Check interest coverage ratio below 2x is always dangerous. Goodwill and intangibles as majority of the assets. Overpaid for acquisition, value may be written off suddenly, destroys equity. Prefer companies where tangible assets dominate always. 3 green signals companies built to last. Green signal number 1, growing reserves, equity rising every year, company retaining profits and reinvesting in growth, shareholders getting richer. Green signal number 2, current ratio above 2. Rupees 2 of the assets for every rupee 1 of near term obligations. Fortress balance sheet survives any downturn. Green signal number 3, declining debt, long term borrowings falling year on year, company self-funding its growth, not depending on the banks. It's a very important thing to look at. Now let me show you exactly how to access the balance sheet in another 60 seconds using screener.in, completely free. Step 1, go to the screener.in and search for a company you are interested in. Step number 2, on the company's page you will see the balance sheet tab at the top of the checklist. Step number 3, you immediately see the assets liabilities of the company in a clean table format going back 10 years. Step 4, look for the current ratio listed in the ratio section. Is it above 1.5? Step 5, scroll down to see the reserves line under the equity. Is it growing every year? Step 6, check the borrowing line under the liabilities. Is it stable or declining? These 6 steps takes 3 minutes and they tell you whether the company has a strong or a weak balance sheet before you read a single line of the annual report. Let me close with an analogy that will make the balance sheet permanent in your memory. Think of a company like a house. The assets are the house itself and the furniture inside, the car in the driveway, the liabilities of the home loan, the credit card bills, any money borrowed to buy these things. The equity is what you actually own after paying all the loans. If you bought rupees 1 crore house with 70 lakh loan, your equity is only 30 lakhs. Every month you pay your EMI, your loan reduces, your equity grows. A company works exactly on the same way. Growing equity over time means the business is building genuine wealth for its owners. Negative equity means the company has consumed more than what it has created. The balance sheet is not complicated, it is just a story of what the company owns, what it owes, and what remains for you. Now, the action steps, call to action. Your 4 action steps for today. Step 1, open a screen, red dot in. Right now, search in any company you currently own. Step number 2, click the balance sheet tab, find the current ratio, is it above 1.5? Step number 3, check the reserves line, is the growing every year? Step number 4, check the borrowing line, is it stable or falling? Or if the 3 passes, that is a strong balance sheet. If anyone fails, you know exactly what to do. Investigate further before you take the next investment decision. Comment below and tell me which company did you check and what was the current ratio. I read and reply to every single comment every day, and if this episode gives you a new skill, please share it with one of your friend who has never read the balance sheet. You could genuinely protect them from every expensive mistakes. See you in episode 13, where we tackle profit and loss statement, a companion to the balance sheet. Please like, share, subscribe, and write your comments, write your feedback in the comment box. And thanks for watching.